Well, guys, it's time for that update once again. What is going on with leveraged debt and retail traders? In today's video, we take a look at how it could be possible that we are 4 times larger in terms of single stock leverage than we were last year at very similar prices. And to make matters even worse, yields really haven't gone down that much. With copper spiking a lot based on a 50% tariff from Donald Trump and Bitcoin potentially poised for a massive breakout, there's a lot to discuss in today's video. So join us as we cover stocks, commodities, and cryptos to break it all down together. Guys, this is not to be missed. These stats will absolutely shock you. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big flows, and of course, that big one, debt. What exactly is retail up to? If it's your first time here, remember to subscribe and smash that like button if you love markets like we do. But let's kick things off here with taking a look at the latest margin statistics. Now, you may already be aware if you've watched this channel for a long time that I often go back and have a look at margin every so often to get the latest reports. And one of the reasons is because before any great global kind of crash, we generally see people taking on too much debt. Now, you may be aware based on credit cards, based on maybe cars or other things, that people are certainly leveraging themselves up right now. But one of the things that I really wanted to mention here was that we have now almost approached an all-time high, and I believe with the latest data that's coming up very soon, so we'll have this on the channel, we will go to an all-time high in regards to FINRA margin statistics. But this doesn't even show the full encompassing of the debt right now in these markets, because when we take a look at single stock leveraged ETFs, this has been growing at an astronomical pace. And considering that the market is basically at the same price as it was in 2024 near the peaks, yeah, you'd be wondering, how is this possible? And it turns out that it's mostly us. Retail traders are going ballistic on single stock leveraged ETFs, particular things such as Hood leveraged, PLTR leveraged, and many others. And while inherently this is, of course, exacerbated gains, ultimately it's going to be, rug pulled by Wall Street. They love to do this eventually, and it always happens that way. And it reminds us a lot of 2021. If you were trading during that time, you would remember the hyper stocks, which were moving 10, 20% on a session, and then ultimately they all blew up. But at the same time, remember, that was not really levered in the traditional way of a leveraged ETF that's now becoming so normal. This is allowing retail investors and traders that don't necessarily know what they're getting into basically make bigger bets on the markets. And it's a cause for concern as this now rises up, and I would expect it to continue even more crazily into the second half of this year. So why is this important? Well, we've seen kind of a switch in markets when it comes to what's going on right now. We've gone from everybody climbing the wall of worry to now everybody being FOMO. And as you guys know, there's a trend line that's coming up that's pretty important for the markets. And we've just seen new tariffs kind of starting to be implemented, such as that 50% tariff on copper. Now, markets haven't freaked out yet because I guess they don't really believe it's going to stick based on some previous knowledge. But at the same time, if it does stick, remember, this is going to put huge shockwaves through the market. Copper is very important to global growth, and it is often seen as Dr. Copper, the kind of read of strong markets or weak markets. So it's kind of being manipulated almost at this point. Another thing that's kind of worrying and concerning here is this post from Mike Zaccardi, courtesy of Goldman Sachs, which basically shows that mostly we are getting a huge amount of momentum switch. We've gone from super low momentum, super basically risk off, to super risk on just in the last 3 months. And this will come as no surprise. We're in a V-shaped recovery, and obviously strength does continue generally to bring strength. Now, one of the reasons for this has also been buybacks. Take a look here. The S&P 500 announced buyback plans. Initially, we thought this was going to be a bumper year of buybacks. Then it dropped off during that whole tariff stuff, and then it came back big time. And you can see here that buybacks have been where a lot of companies have been putting their money. And the main reason is because they're not investing in the future. A lot of them aren't doing that. And this is causing, of course, inflation, or in terms of inflated growth more so, inside the stock market. We know that buybacks have been artificially one of the main reasons propping up the US market for years, along with debt. And of course, in this case, it's back here at this point. So everything's all good. Well, I guess, in many ways, I guess we would look at this and say, okay, things are looking pretty good. Technology is leading. Defensives have, of course, been dropping off. And other than the last 48 hours, so 48 hours ago, we got a little bit of a spike in defensives. We've generally been seeing tech, semiconductors, and hyper stocks leading the charge. And that is usually a pretty good sign. In fact, I went and posted over on our LinkedIn or my LinkedIn over in the links in the comments down below. And I posted some of the things that you generally want to be looking for in strong bull markets. Now, if you're ever looking at strong bull markets in the future, let's say we pull back, we end up getting back into another strong bull market, then of course you want to be checking out this type of stuff. Links in the pinned comment down below, and of course in the description if you want to follow me there. I'll be posting a whole bunch more on psychology of markets and of course things to look out for, helpful tips. So definitely follow us there if you want to. Now, what about S&P and the expectations of the street? Well, we know they're generally wrong. Of course, we've seen this already this year. They came out kind of going for 7,000, 7,200 this year. Then they pulled it back down to about 5,600, 5,500 during the tariff period. And now everyone seems to be back at around 6,600 by the end of the year, based on the latest survey results and latest PE ratios. So will that be correct? Well, one of the things about this market has been that we've rallied into the period of time that you generally rally into. And then we tend to see a slowdown or pullback or sideways style market. And this makes some sense. If you think about it, Christmas in July kind of goes through to the middle of July. Then we kick earnings season off. The 15th of July will be worthwhile watching. And valuations are starting to get high again. So we're going to need to see that the earnings are coming along with the market's expectations post, of course, these tariff implementations. We're also going to need to see a lot to do with these big companies, Nvidia, TSM, Meta, Google. How have they performed? Have they done enough in terms of bringing AI growth to America? And have they sacked enough staff as well? Because, of course, this is going to be what the street is looking at moving forward in terms of becoming lean, mean, trim AI machines. Will that end up causing the markets to continue to rally higher? Well, it is an expectation, but we've got to remember that year threes of bull markets, especially after what we've seen, especially when we consider that there's some pretty big tax policy switches and all things that are going on right now with the US government, that generally brings us to a sideways style market. Kangaroo in many ways, up, down, up, down, up, down, up, down. And we've just had one of the strongest recoveries ever recorded, which is not a bad thing. And of course, this often brings what you would say is some form of consolidation. It happened in 2020 and it could be happening now. In fact, it's pretty common as well when you look at presidential years, how this market is kind of playing through. And you can see here that we're getting to the stage now where the rest of the year is less likely to be super bullish as everybody goes ballistic, but at the same time, leverage is up big time across the board. That's FOMO right there, guys. Advanced decline line is up, which of course is a decent sign for markets. US dollar is down, which is making the US markets look comparatively cheaper if you're from overseas. And of course, we've talked about this in our previous video, whether the dollar is now starting to baseline for now. And we've even seen large cap stocks starting to break back up that have been, in the doldrums. These are ones that have formed bases for a long time, done nothing, and they're kind of like those value plays. So when you see the value play market pick up, you see the Russell 2000 pick up, that's a broadening of the market rally. And so far, we've been fixated on the semiconductors and the tech. Now it seems to be kind of broadening. And that can still force the markets to have a sell-off because big tech could sell a little bit. People could move into these defensive sectors, and that actually causes a fair bit of range movement in the markets themselves. What about crypto? We already know that deregulation is coming. Crypto is going to be used potentially to buy houses and other forms of debt market. Tokenization is here. Everybody's going ballistic about this. And what that's doing is it's causing a lot of inflows into the crypto markets. So at the moment, Bitcoin, Ethereum, and other cryptos are all poised for a massive move, but we haven't seen them break out yet. Some points to watch on the horizon. We already knew that, of course, we were going to see a lot of tariff discussion this week, so that's been happening. Next week, though, JP Morgan's report and US CPI. Make sure to pay attention to those two. That is probably going to be one of the big move days. That's the 15th of July. And of course, we'll have coverage for this earnings season, including implied volatility moves based on the options market for all of the main stocks. Let's have a look at the S&P. Same thing as pretty much yesterday. We're still at that kind of overbought level. We're very close to that overall trend line, which we've talked about a lot now recently. And of course, we've also seen in some places a completion of a flag pattern. So if you have a look here, if we took the flag from the bottom to the top, then you would get that. And if we were looking for completion by some textbooks, then you would be looking at the top of the trend line. So we're basically in that box area, which is starting to get dangerous here for the markets. And with 50% tariffs now coming onto copper, if that does stick, it could certainly be a reason why markets may pull back. Levels to watch, weekly 20 and daily 20 moving average. Both of those will matter. And these are the updated options high lows. Now, why is it becoming more apparent that we might see a sell-off? A lot of it has to do with just the absolute stacking of calls across the board. We've been in super FOMO and we've seen a lot of people buy up. Take a look here at some of these December positionings here for this year. 67.50 stacked, 65.50 stacked. So people are really looking at a super bull end to the year and a lot of calls now coming into play. Now, if we're looking at even the July OPEX, so that is the big options expiration of this month, there's clearly less puts than there are to the call side. And everyone seems to be stacking around 62.50 and 6,300. So if we do keep moving up, that's going to create positive gamma. But I wouldn't be surprised at all to see the street trying to take a little bit of profit off retail traders and other options traders by keeping this market relatively under this 63 level. It's a very important level for markets. And of course, we'll be watching flows a lot. In the Tesla side, 280-300 holding for now. And you guys know how important that is to hold. And yeah, Elon versus Trump, I guess, has started to pick up again in after hours. We'll see what ends up happening with that. But certainly it does make the stock a lot harder to trade. But just remember, 280-300 is a put wall. If we drop that, it could be 240, just like that. Let's move over to NVIDIA. It's still the 160 level. And you guys know that we're basically at that 160, 165. NVIDIA has been an exceptionally good stock. We have been bullish on it, and we continue to really look at it as one of the leaders of the pack. So we want to see semiconductors continuing to lead, and that has kind of frozen out over the last couple of sessions. We're seeing it consolidate, and we're looking for the largest transactions. We don't have any big ones yet to note. We also did see a little bit of a spike up in the bonds market, and in terms of option spreads, we're basically seeing a little bit of risk off starting to happen. Now, this is nowhere near enough to say, oh, wow, we're at the top, it's going to sell. But certainly the first sign of a pickup for weeks and weeks and weeks in terms of one of our lead indicators to risk kind of problems. And we also saw a bunch of calls coming back in. The put call ratio actually dropped down here, signaling that a lot of people were buying calls over the last 24 hours. And we can see that in those results. But of course, there are less puts in. Usually when the puts are up here, it's a pretty good time to be looking at technical buys. For now, it's kind of like a, maybe an overbought or slightly, neutral market in many people's minds. What about dollar? Well, we did talk about the US dollar starting to pick up. It does look like that's what's happening. And you can see here, it's making a series of higher highs and higher lows. This is against the media. So remember, if it's in the press, it's often in the price. And US dollar is super bearish right now in terms of how people have positioned. And we hit the level that we thought we would. So from a technical level, I'm super neutral, actually bullish at this stage. And what that means is that I would be looking more at the buy end than the sell end. Even though the overall trends, weekly, monthly, daily, are all down, you can see the small time frames are giving a little bit of that boost. And that's why we brought it up over the last couple of videos, the way that we've seen it. Now, this has put a bit of pressure on things like gold. The tariff stuff didn't help either. So what this is doing is it's pushing gold down. Big level to look for gold is going to be 33.60. Still bullish on it on the medium, longer term in terms of investment. But yeah, for day traders, geez, we need 33.50, 33.60 to be broken. That's going to be a strong one. And the same thing's happening here for silver. You guys know I'm bullish it. But at the same time, while it's holding and it's trying to do its best, it needs to break these levels and to continue up. Obviously, we're looking for a 37 plus to really get momentum started. And with US oil, it's more of the same. If you bought down here, well done to you. And it's creeping higher, but it doesn't look particularly good, I think, on the charts. Tesla, 280, 300. You guys know this is where the support basically sits for it. No new updates for that one. And semiconductors are stuck at the peaks. So yes, they've come in really bullish. You cannot say there's a sell here yet, but from a technical side, we're at that point where you generally do start to see consolidation. Now, what has happened in the markets is we've started to see a bit of rotation. Russell 2000 is beating the SPY kind of regularly here on the daily. So it's not absolutely going ballistic, but certainly it's starting to improve. A 0.36 ratio break will be an important point. We haven't quite seen that yet. And Chinese markets just continuing to flounder near the peaks, kind of coiling for the next big move. So we've discussed this a little bit, correlation across markets. S&P 500 close to the 63, 63, 30, 20 area that we've been looking at. US 2K very close to that correlation supply, which is at 2280. And of course, the NASDAQ very close to the trend line as well. With this many markets correlated at the peaks, with dollar where it's at right now, could we be looking at a little bit of a pullback? It's very possible. I mean, we haven't seen correlation like this in a little while, and we're very close to it. So I would say, caution, watch the markets. If you're bullish, of course, there's no real reason yet to say, wow, I've got to be out. The leverage that we talked about from retail, that doesn't affect the markets like this, but it's certainly something to be worth paying attention to. Now, when we go over to the crypto markets, you can see Ethereum continues to be pretty strong, and Bitcoin has been, well, how would you say it, coily. So this particular market, I've made a case for quite a few bullish positions, potentially here coming through over the next months. And that's because, of course, deregulation and borrowing and just frankly, the banks getting into it. But you guys know the 110 break close is going to be a huge level. And we're watching this from a coil perspective. When something coils before its all-time highs, I usually love it when it breaks up. So if it does break up, then that's going to be strong. If it does wipe a low and then come forward, it's going to be ballistic. Like that would be huge. But at this point, it's right near the peak. We're waiting for that breakout to occur. Guys, at the moment, these markets can be looking tricky. Generally speaking, I would say that it's at that point where you want to be looking and specifically picking kind of the positions and the choices that you're making. It wasn't as easy as like 2 weeks ago or a week and a half ago where we went, okay, this market's going to squeeze and keep squeezing higher. We're getting towards that toppy end. And you're starting to see this in a little bit of unnatural movement in the markets. They're selling off, they're rallying up. We just don't have the big dark pools yet. So we're going to be watching very closely. If you enjoy this content, remember to subscribe, smash that like button, and I'm looking forward to bringing you the latest updates over the next couple of days. I think we could be in for a doozy. Let's find out if we are. Bye for now.